Hello, good morning. Today we will discuss about self-insurance, their group health insurance plans. So let's start. Self-insurance. Our discussion of retention would not be complete without the brief discussion of self-insurance. The term self-insurance is commonly used by risk managers to describe aspects of their risk management programs. Self-insurance is a special form of planned retention by which part or all of a given loss exposures is retained by the firm. A better name of self-insurance is self-funding, which expresses more clearly the idea that losses are funded and paid for the firm. Self-insurance is widely used in workers' compensation insurance. Self-insurance is also used by employers to provide group health, dental, vision, and prescription drug benefits to employees. Firms often self-insurance their group health insurance benefit because they can save money and control health care costs. There are other benefits of self-insurance as well. Insight 3.1. Here is the 3.1 insight, and there have a briefly discussed in this. We will discuss this later. Finally, self-insurance plans are typically protected by some type of stop-loss insurance that limits the employer's out-of-pocket costs once losses exceed certain limits. Risk retention group. Federal legislation allows employers, trade group, government units, and there is a from self-insurance their group health insurance plans. Self-insured group health insurance plans is one in which the employer assumes the financial risks for providing health insurance to its employees. In practical terms, self-insured employers pay out of pocket expenses as they are incurred instead of paying premiums to an insurance carrier, which is known as a full insured plan. Typically, a self-insured employers will set up a special trust fund to earmark money, corporate and employee contributions to pay incurred claims. Employers choose the self-insurance option for several reasons, including the following. There is a sum of key feature plan we should discuss. Number one, the employer can customize the plan to meet the specific health insurance need of its workforce as opposed to purchasing an one-size-fits-all insurance policy. Number two, the employer maintains control over the health plan reserves, which maximizes interest income that would otherwise be earned by an insurance carrier from the investment of premium dollars. Number three, the employer does not have to prepay for coverage, which improves cash flow. Number 5. The employer is not subject to conflicting state health insurance regulation and mandated benefit because insured health plans are regulated under the federal law Employee Retirement Income Act of 1974, or it is the next one is the employee is not subject to state health insurance premium taxes, which generally are 2 to 3% of premiums. The last one is the employer is free to contract with the healthcare providers or network providers that best meet the healthcare needs of its employees. Other parties to form risk retention group. A risk retention group is a group captive that can write any type of liability coverage except employer liability, workers, expansion, and personal lines, and it is the include of the risk retention groups. The another topic of this part. For example, a group of physicians may find medical malpractice liability insurance difficult to obtain or too expensive to purchase. The physicians can form a risk retention group to ensure their medical malpractice loss exposures. Risk retention group are exempt from many state insurance laws that apply to the insurer Nevertheless, there must be licensed as a liability insurer at least one state. Here is the advantage and disadvantage of retention. So let's start. The retention of technique has both advantages and disadvantages. In a risk management program, the major advantages are false. Number 1. Save money. The firm can save money in the long run if its actual losses are less than the loss component in a private insurer's premium. Number 2. Lower expenses. The service provided by the insurer may be provided by the firm at the lower cost. Some expenses may be reduced, including loss adjustment expenses, general administrative expenses, competition and bookers, fees, loss control expenses, taxes and fees, and in shared profit. Incurs loss prevention because the exposures is then the remainder greater inactive for loss prevention. Increase cash flow. Cash flow may be increased because the firm can use the funds that normally would be paid to the insurer at the beginning of the policy period. The retention technique, however, has several disadvantages. We already discussed about this advantage of this retention, the real retention group, risk management group. Now we will discuss about the disadvantages about this retention. Possible higher losses. The losses retained by the firm may be greater than the loss allowance in insurance premium that is saved by not purchasing insurance. Also, in the short run, there may be great volatility in the firm loss experience. Possible higher expenses. Expenses may actually be higher. Outside experts such as safety engineers may have to be hired. Insurers may be able to provide loss control and claim service less expensively. Now let's go to the next page. Possible higher taxes. Income taxes may also be higher. The premium paid to insurer are immediately income tax deductible. However, if retention is used, only the amounts paid out for the losses are deductible, and the deduction cannot be taken until the losses are actually paid. Contribution to a fund reserve and not income tax deductible. So here today this is our topic. We already discussed about self-insurance, risk retention group. The most important is insight. Why do firms self-insurance their group health insurance plans? So already discussed it briefly. Hope all students understand very perfectly. So today this topic our end. We will discuss another topic the next video. So everyone should take care. Bye for now.